Dividends are one of the only truly passive income streams that exist. You can invest in a portfolio of companies and earn a portion of their earnings paid right out to your brokerage account. Or you can simply invest in a high dividend ETF and be invested in hundreds of different dividend-paying stocks. No matter what strategy you're looking to follow, this is going to be the ultimate guide to dividend investing for beginners. We're going to be covering what dividends are and why some companies pay them, key financial metrics you must be familiar with, what are the best dividend stocks and ETFs, as well as the pitfalls to avoid, and so much more. And feel free to skip ahead at any point in time using the table of contents in the description below. Let's dive right in. Let's start off with the basics, such as what is a dividend? When a company has positive earnings, they have two primary options as far as what they do with those earnings. If they are in growth mode, they will often reinvest those earnings back into the business, and this could mean saving up money to acquire a competitor, for example. However, there are hundreds of well-established companies out there that are not necessarily looking to grow, and that's because they've achieved near market saturation. Take Coca-Cola, for example. They've been around since 1886, and they have been growing their portfolio of brands for over 130 years now. At this point in time, you could drink one new Coca-Cola beverage every single day and not run out of new drinks to try for over 9 years. Coca-Cola has more than 3,500 different beverages under over 500 different brand names. So a company like Coca-Cola is generating consistent profits, but they hit a ceiling a long time ago in terms of their growth factor. So what they do instead of reinvesting all of those earnings is they actually share a portion of those earnings with the shareholders in the form of a quarterly dividend payment. In most cases, dividends are paid out on a quarterly basis, but you also have monthly dividend paying stocks as well as some stocks that pay dividends once or twice a year. Now, there's an important distinction between these two groups of companies that we've just talked about here. The ones that are reinvesting their earnings to grow as fast as possible are referred to as growth stocks. And the companies that are simply operating in a consistent manner and then sharing a portion of their earnings with the shareholders are called income stocks. For growth stock investors, a return on investment is going to be generated through the business becoming more valuable over time, and in turn, the share price becoming more valuable too. Income investors may still see some appreciation in the underlying share price, but much of the returns generated will be from those dividend payments. You also have some companies that fall in the middle, where they are reinvesting earnings to grow the business, but they're also paying out a dividend, and these are referred to as dividend growth stocks. One common misconception out there about dividends is whether or not companies are actually required to pay them. There's actually no set requirement out there that says that a company must pay dividends to their shareholders, except for special dividend stocks such as REITs. These REITs own a portfolio of real estate, and they are required to pass along at least 90% of their taxable income to shareholders in the form of dividends. But aside from that, in a few other special circumstances, there's no set rule that says a company of a certain size must pay dividends to the shareholders. Instead, it's something that is determined by the board of directors of a company. Normally, the decision to pay a dividend or not is going to be put to a vote where shareholders are able to decide whether or not they want to have dividends paid out, but keep in mind, not all shares have voting rights. But even though paying a dividend is not required, keep in mind that if a company decided to be greedy and retained all of their earnings to pay big bonuses to the executives, for example, shareholders would bail, and that would have an effect on the share price. Since most people at the top of a company are paid at least partially in company stock, it's in their best interest to do what they can to maintain a high share price. So that's what dividend stocks are, but why do people invest in them? The first reason is because this opens up two potential avenues for getting paid by a stock or a dividend fund. Growth investors can only make money through asset appreciation or the share price of the asset going up over time. But when you own investments that pay dividends, you can now get paid in two different ways. You can make money from the asset appreciation, but also the dividend payments. Earning dividends also gives you the benefit of being able to reinvest them to earn more future dividends. And if you want to learn more about that, be sure to check out my compound interest explained video that I just did. I'll put a card in the corner for later. When you earn a dividend, it will be paid to your brokerage account in cash, or you can enable automatic dividend reinvestment. Dividend reinvestment, or DRIP, means your dividend will automatically be used to buy more more shares, likely fractional shares, of whatever asset issued the dividend in the first place. Now, depending on what phase you are at in your investment journey, you may decide to reinvest those dividends, or you might take that cash and use it as a means of income. However, it's extremely important to understand how taxes factor into this equation. When you earn dividends, you're required to pay taxes on those earned dividends, even if you just reinvest them. That's why the type of investment account that you use for dividend investing is extremely important. If you invest through a taxable brokerage account, you'll be paying up to 20% tax for the federal level on your dividends, and there could be additional state taxes owed too. Let's say, for example, you have a $1 million dividend stock portfolio after decades of saving and investing, and you earn a 4% yield on that portfolio in dividends. Well, that would be $40,000 per year in dividends, and if you owed 20% of that in taxes, that's going to be $8,000 per year as your tax bill on those dividends. That means you'd either have to pay that money out of pocket separately, or take that $8,000 out of your portfolio by selling off some assets at the end of each year. But if you want to avoid those taxes entirely, you could invest through an individual retirement account, in particular the Roth IRA. Now, I just did a full Roth IRA tutorial for beginners that I'll put in the corner for later, but let me give you a quick explanation. With a Roth IRA, you can't touch the earnings of the portfolio until the age of 59 and a half, but if you follow that rule, as well as a few other simple rules, your investments grow completely tax-free, including the dividends. So if you're investing for retirement and possibly thinking about using dividends as a source of income later in life, you should really look into this type of retirement account. I'm also going to be doing a full retirement planning video later this month, so make sure you subscribe and hit the bell to be notified when that comes out. And while we're on the topic here of taxes and retirement accounts, let me tell you about our video sponsor, iTrustCapital. This innovative company is putting a new spin on old school retirement accounts by offering crypto IRAs. Simply put, you can invest in Bitcoin and other alternative crypto assets in a 100% tax-sheltered manner. A lot of people expect Bitcoin to reach new heights later this year, now that we've had another block reward halving and, of course, the ETF approval. But keep in mind, you'll have to pay taxes on all of those crypto gains if you're not investing through a retirement account like a Roth IRA. And get this, if you have an existing retirement account that's hanging around, you can roll this over and use those funds to invest in Bitcoin or other crypto assets. So if you've been waiting on the sidelines but haven't had the funds to make a crypto investment, a rollover could be your ticket. So click the link in the description below to learn about how iTrustCapital could help you shelter your crypto gains from taxes. And if you're just simply looking to learn more about how this works, you can click the link down below and hop on a call with their support team. They are there to help you and answer questions, not to hard sell you. To date, iTrustCapital has completed over $8.7 billion in total transactions on behalf of over 200,000 investment clients. So click the link down below to get started today. Now let's get back to the video. Now we're going to cover some of the key metrics you need to be aware of as a dividend investor, starting off with the key dates surrounding dividend stocks. First, we have the declaration date. This is the date when the board of directors announces an upcoming dividend payment. In that announcement, they're also going to be sharing at least two other dates. That is the record date and the payment date. Now, the record date or date of record is the date the company uses to determine who will be receiving the dividend payment. Now, to make things a bit simpler, there's also something called the ex-dividend date, which is normally one business day before the record date. The ex-dividend date is the cutoff date for determining who will receive the dividend. If you buy a stock the day before the ex-dividend date, you will receive the upcoming dividend payment. However, if you buy a dividend stock on the ex-dividend date or any time afterwards, the seller is going to be the one who receives the dividend payment. So really, the ex-dividend date is the most important and the one that you really want to pay attention to as a dividend investor. And finally, we have the payment date. This is the date that the checks will be mailed out, or in most cases, the cash will be deposited to the brokerage accounts. The reason why this is so specific is because some people will try to follow follow more advanced strategies like the dividend capture strategy, where you try to buy a stock right before they pay a dividend, you collect that dividend, and then you sell that stock and ideally make a small profit. However, in this day and age especially, the stock market is extremely efficient, and dividend payments normally get priced into the share price, so you're better off to just follow a longer term strategy instead of trying to make short-term trades like that. Moving on now, let's talk about the dividend yield. This is the percentage that a company pays out in dividends relative to its share price, and it's calculated by taking the annual dividend payment and then dividing it by the share price. Now, since dividend payouts and the share price both change over time, the yield that a stock or fund pays is also going to change over time. Let's say, for example, you have a stock trading at $100 per share and they've paid out $4 in dividends over the last 12 months. You would take that $4 in dividends and divide it by $100 in terms of the share price, and that would give you 0.04 or 4% as the dividend yield. But there is a catch here when it comes to high yielding dividend stocks. Oftentimes, this could simply be a result of a stock having a share price that's declining in value. If the same stock in the previous example dropped to a share price of just $50 but still had the same $4 in annual dividend payments, you would divide the $4 by 50 and end up with 0.08 or an 8% dividend yield. Inexperienced dividend investors might see an 8% yield and think it's a great deal because it's so much higher than everything else out there, failing to realize that the only reason why the yield is so high is because the share price has dropped. The crazy thing is, companies can even pay dividends even if they cannot actually afford to do so. In most cases, they're just trying to keep investors on board because they're pretty desperate. That's why it's crucial to understand the next metric here, which is the dividend payout ratio. This ratio will help you understand whether or not a company can afford their current dividend payment, and it's calculated by taking the annual dividend payout and then dividing it by the company's annual net income. But you can also just search for this yourself instead of doing the math. For example, Johnson & Johnson has a dividend payout ratio of 30.4%. This means that out of every dollar that they are earning after expenses, about 30 cents goes to the shareholders in the form of a dividend, and 70 cents is retained and then reinvested back into the business. Now, a stock like AT&T, for example, pays a higher dividend yield and has a payout ratio of 59.9%. However, that is not always a good thing. If you compare the share price of Johnson & Johnson to AT&T over the last 5 years, Johnson & Johnson has returned 7.35%. Meanwhile, AT&T stock has declined by about 27%. So when you're researching potential dividend stocks to invest in, you always have to consider both the dividend return potential as well as the performance of the underlying share price. Ideally, what you'd be looking for is a healthy yield with modest asset appreciation. And this brings us to our last key metric to look at, and that is the historical dividend payout and whether or not this has been growing over time. Companies that have a consistent history of paying dividends are going to be more sought after, and among these, there are some that have even grown those dividend payments each year. For example, Johnson & Johnson has managed to grow their dividend payment every single year consecutively for the last 52 years. On the other hand, a stock like AT&T only has 1 year of consecutive growth, as they've clearly faced challenges with their business. So you should always be looking into the dividend history and whether or not a company has been consistently paying the dividend as well as growing that dividend over time. Now, let's dive into some of the best dividend investments. If you're looking to invest in individual dividend stocks, one of the best places to start that search is the list of dividend aristocrats. This is a list of S&P 500 companies that have grown their dividend every single year in each of the past 25 years or more. There are currently just 68 companies total that make this coveted list, and that's because it takes a lot of work and discipline to get on this list and also maintain that placement. Now, I'm not going to get into individual dividend stock picks in this video. Perhaps I will in a future one, so make sure to subscribe and hit the bell for that. But I will tell you a small handful of dividend aristocrats that I've owned in the past that I've done well with. You have Coca-Cola, the beverage giant, Procter & Gamble, the consumer products giant, and then there's Walmart, Caterpillar, McDonald's, and tons more. However, picking individual stocks can be a lot of work, work. And in addition to that, you have to keep an eye on what these companies are doing over time to make sure that they are remaining a good investment. An alternative strategy that many follow is investing in a high dividend yield ETF. These fund investments own a large portfolio of dividend stocks within them. That way you have built-in diversification across dozens, if not hundreds, of individual companies. For example, there's NOBL, the S&P 500 Dividend Aristocrats ETF. This fund allows you to invest in all of the dividend aristocrats together in just one investment. Another popular option is VYM, the Vanguard High Dividend Yield ETF, which owns over 500 different companies that pay dividends. These funds collect all of the individual dividend payments that are paid out by the stocks owned within the portfolio, and then they pay out a single dividend on a quarterly basis. For example, the current dividend yield for VYM is 2.86%. With a fund investment, the yield is often lower than individual dividend stocks, but that comes with the benefit of having diversification across all of those different companies. Now, let's cover what you should keep in mind when building your dividend stock portfolio. Above all else, diversification is the name of the game when it comes to dividend investing as well as other forms of investing. Imagine, for example, if you dumped all of your money into AT&T stock 5 years ago because you saw that it had an above-average yield. Well, a $100,000 investment would be worth just $73,000 today, assuming that you didn't reinvest your dividends. And even if you did reinvest those dividends, it would still more than likely be a negative overall return. If you had instead put $100,000 into VYM, the Vanguard High Dividend Yield ETF, the performance over the last 5 years has been about 35%, meaning that you would have about $135,000, not including any dividends that you earned. That's why diversification is so important. If you pick the wrong stock, you can lose a ton of money. If you're picking individual stocks, you also need to consider the type of industry that they are a part of. There are defensive industries, which are businesses that tend to be immune to economic fluctuations, such as power utility companies, for example. And then there are cyclical industries, which are businesses that are sensitive to the underlying economy, such as restaurants, for example. It's no coincidence that most of the dividend aristocrats are in defensive industries that see consistent spending no matter what. During a prosperous economy, companies in cyclical industries will often outperform, but during the bad times, companies in these defensive industries are going to be far more durable. Now, in addition to understanding the type of industry that a company is in, you also should have an understanding of the different business sectors of the economy. A sector is a defined segment of a broader global economy, and these are businesses that share the same related product or service. For example, the financial sector is all of the firms and institutions that provide financial services like banking and more. If you're choosing individual dividend stocks, you want to be diversified across all of these different segments of the global economy. The last thing I want to cover here are some common pitfalls to avoid as a dividend investor. First and foremost, you need to avoid chasing after high-yield dividend stocks. As you now know, a high dividend yield could simply be a result of a share price that's on the decline, and that will cost you far more than you're earning in dividends. Make sure you're looking into that dividend payout ratio as well to make sure that a company can reasonably afford to pay that dividend. In addition, you should also explore learning more about fundamental analysis if you want to own individual dividend stocks. This will allow you to better understand the overall financial health of a company, which is going to have a significant impact on their ability to pay and potentially grow dividends over time. And lastly, you need to avoid the pitfall of failing to diversify. It may not seem important during the good times, but when we inevitably enter a recession, that is when you will realize how important this is. So before this happens, take the necessary steps to diversify your portfolio. If you own individual stocks, for example, consider whether these are in defensive or cyclical industries. And in addition, consider what sectors are carrying the most weight in your portfolio and whether or not you have too many eggs in one basket. Always keep in mind as well that you can simply own an ETF or exchange traded fund if you don't want to worry about stock picking and you want to be diversified across all different types of companies. This of course has many benefits, but the biggest one being built-in diversification. There you have it, guys. That's an A to Z guide on dividend investing for beginners. If you have any questions, leave me a comment down down below, and I will do my best to answer those. If you made it to the very end, be sure to drop a like as well as subscribe, hit the bell, and turn on all notifications. That way you don't miss my upcoming video on retirement planning. And again, don't forget to click the link in the description below to learn more about I Trust Capital and their $100 funding bonus. You can click below to watch my video about how to invest in the S&P 500 for beginners, and I'll see you there.